of the business entity. Let me repeat that point. Strategic financial management is an aspect of management, or is an integral part of management that is concerned with how companies source financial resources, how companies utilize financial resource so as to meet the objective of the business entity. Now let's go to the topic. If we ask ourselves, what is the primary objective of a business entity? The primary objective of a business entity is to maximize the wealth of the owners. Companies are into business in order to maximize profits, to meet the expectation of the business owner. If you look at the definition we provided regarding strategic financial management, that strategic financial management is about how a company sources finance, how the company utilizes finance to meet or to maximize the wealth of the shareholders. How companies source finance, how company utilize finance to meet the objective of the business owner. In other words, the objective of the business entity is to maximize the wealth of the owners. Now, what is corporate failure? Where a company cannot make sufficient return, where a company cannot achieve sufficient return to meet the expectation of the business owners, then we have corporate failure. Let me take that again. Corporate failure may be defined as the inability of a company to achieve satisfactory return on investments. You can also define corporate failure as a situation where a company cannot achieve sufficient return to meet the expectation of the business owners. It involves, or it is a situation where company cannot consistently, that is the keyword. Company cannot consistently achieve sufficient profits to meet the expectation of the owners of the business. In that situation, we say there's corporate failure. We have tried to define corporate failure. What could give rise to corporate failure is what we call financial distress. If a company is in financial distress, corporate failure will follow, unless the company's problem can be identified and corrected. Are you there, please? If a company is in financial distress, that company will experience corporate failure unless the management of the company can identify the problems and take corrective action. Therefore, it is important to understand or to recognize the causes of financial distress. Look at the sequence. We define corporate failure. We now say, if a company is in financial distress, that company will suffer corporate failure. We now want to know, what are the main causes of financial distress? Causes of financial distress. 1, revenue failure. Where a company is losing on sales volume. Where there is reduction in company sales volume, that is revenue failure. Where a company suffers reduction in sales, revenue failure. Where a company accepts a business that does not contribute to the growth of shareholders' wealth, that's revenue failure. Is that clear, please? It's like saying a company accepts a project, but that project is not adding value to the company. That's revenue failure. Where there is revenue failure, this will give rise to financial distress. Financial distress will give rise to corporate failure. Corporate failure will terminate the life of a company. So, one of the causes of financial distress is revenue failure. Number 2, cost failure. Cost failure may occur where you have weak cost control in a business, where you have inappropriate accounting policy. There could be cost failure. Where you have excessive cost burden. Now, where a company is operating at higher costs, that is cost failure. Where a company is having an accounting policy that is not appropriate, this could give rise to cost failure. Where there is no cost control in a company, this could give rise to cost failure. And where there is cost failure, this could give rise to financial distress. Financial distress can give rise to corporate failure. Failure could lead to termination of a company's life. Number 3, failure in asset management. Failure in asset management include failure to invest in appropriate technology. Where a company fails to invest in appropriate technological assets, that could lead to failure in asset management. You can also have poor working capital management. Where a company fails to manage its working capital very well. What is working capital? Recall, working capital is the current assets less current liability. That is the capital used to run the day-to-day affair of the business. Now, where there is poor working capital management, what is poor working capital management? Where you have excess working capital, excessive working capital, that is poor working capital management. Or where you have inadequate working capital, that is poor working capital management. A company must not have excess working capital. That means you are tying down too much cash to working capital. Also, a company must not have inadequate working capital. This could result into poor asset management, failure in asset management. Failure in asset management can lead to financial distress for company. Financial distress will give rise to corporate failure. Corporate failure could lead to companies' bankruptcy. Deliberately, I try to slow the pace to allow students to flow with the lecture. Deliberately, we try to keep the pace to allow students to flow. Now let's look at number 4 reasons. Poor failure in liability management. Of course, company will have liability, but you must manage your liability very well. Company have current liability, non-current liability. Under liability management, a company must be able to manage its relationship with the money market. A company must be able to manage its relationship with the money market. What is the money market? Money market is a market for lending and borrowing on short-term basis. Money market is a market for lending or borrowing on short-term basis. Now, at one point, company may need to borrow money on the money market. That means you must have a cordial relationship with the money market. If you are trying to borrow money you must be able to obtain a favorable borrowing rate. If you are borrowing, interest rate will apply. And you'll be expected to pay your interest and the principal amount borrowed. If you don't manage the interest component very well, that could affect the company. The inability to manage interest rate risk, that could lead to failure in liability management. The inability to manage the financial risk that comes from borrowing. If a company borrows money, there is financial risk. What is financial risk? Risk that if the company fails to pay the interest and the principal amount borrowed, the lender may force the company into liquidation. Therefore, the company must manage its liability. Failure in liability management can give rise to financial distress. Financial distress can lead to corporate failure. Corporate failure can terminate the life of a business. Lastly, we have failure in capital management. What is capital? Capital refers to the resources. Capital collectively refers to the resources utilized by the business to execute its business objective. It refers to the money that the company utilized to achieve its business objective. Company must avoid overcapitalization or undercapitalization. Company must avoid overcapitalization. What is overcapitalization? A company must not have too much capital in the business. Excessive capital in the capital structure is risky. Also, company must not have undercapitalization. Any of these could give rise to financial distress. When you say overcapitalization, you are pumping too much money to the business than the business requires. Now, if you are putting too much money to the business, remember that company will pay. When you introduce finance to the business, there is cost of finance. It means if you put too much money to the business, you are going to incur higher cost on finance. And you are not using the finance to generate profit. Excessive capital into the business. So company must avoid both overcapitalization or undercapitalization. Also, company must maintain a cordial relationship with the capital market. Capital market is the market for long-term finance. Capital market is the market for long-term funds. Remember, please, company may require short-term finance. If a company is looking for short-term finance, company will go to money markets. Money market is where commercial bank operates. If a company is looking for long-term finance, company will go to the capital markets. Capital market is where you have the stock markets, the bond markets. These markets are for long-term finance. So company must maintain good relationship with the money markets as well as the capital markets. Because failure to manage capital very well can give rise to financial distress. Financial distress can give rise to corporate failure. And corporate failure could lead to liquidation of a company. All right. We are spoken for like 25 minutes. Question for 3 minutes question. You can drop question on the chat. Any question, please. Or you can unmute to speak. If there is no question, we can proceed with the class. Let me quickly say that the exam you are going to write is a combination of theories and calculation. If you go back to check past question, you observe that about 45% of the question will be in theories. Why am I saying this? Please prepare for all eventualities. Now, next discussion, corporate failure prediction. Our next discussion is how can we as professionals identify companies that are the risk of corporate failure? We call it corporate failure prediction model. What are the signs, or what are the symptoms, or what are the things we should watch out for that will give us an indication, or that will give us indications that this company is at the risk of corporate failure? Our next discussion is corporate failure prediction model. Our next discussion is corporate failure prediction model. There are two models. There are two models that can be used to predict company at the risk of corporate failure. Let me repeat that point. There are two models that explain causes of corporate failure. One, we have the financial model. Otherwise known as quantitative corporate failure prediction model. The quantitative corporate failure prediction model. The quantitative corporate failure prediction model assumes that company fails as a result of financial problems. The quantitative corporate failure prediction model argues that the main causes of corporate failure are because there are financial problems. Please note, we are not saying the model is correct. When we say a model will be based on assumption. The model is saying that causes of corporate failure are quantitative in nature. That is, they are financial problems. Company fails because they have financial problems. That is the position of the quantitative corporate failure prediction model. The quantitative corporate failure prediction model, that if you want to look at companies, that if you are trying to compare companies, whether the company is healthy or not, go and pay attention to 5 financial issues. That if you want to know that, 1, look at the company's profitability. Where a company is not achieving profit, that company will fail. That is their position. That why company fail was because the company has profitability problems. Number 2, they look at cash flow. That where a company has liquidity problem, that liquidity problem will lead to the failure of a company. Number 3, under quantitative, please note, quantitative is looking at what? Financial problems. That the reasons why company fail was because the company has financial problems. Financial problems are the main causes of corporate failure. They are not trying to itemize that, okay, go and look at the company's profitability. Once there's profitability failure, then that company will fail. Look at the company's cash flow. Once the company has liquidity problem, then the company will collapse, will fail. Look at return on equity. Where a company cannot return sufficient to the investors, then that company, the inability to return sufficient to the investors. Investors here refer to the equity holders, will lead to corporate failure. They talk about Jerry. That is where a company have excessive borrowing. Excessive borrowing will have impacts on the survival or otherwise of a company. And they mention volatility in business revenue. Where a company's revenue is highly exposed to fluctuations, where a company's business revenue is highly exposed to fluctuation, that's volatility, then that company is at the risk of corporate failure. In summary, the quantitative model is saying that company fails because of financial problem. Hence, we can use financial ratios. We can use financial ratios to predict companies at the risk of corporate failure. Please note that point. The quantitative corporate failure prediction model, they argue that companies fail because of financial problems. Hence, we can make use of financial ratio to predict companies at the risk of corporate failure. Under the quantitative model, a notable model used is called the Z-score. Look at my highlighted, please. A notable model used is called the Z-score. Just 1 minute. Just 1 minute, please. I want to add something to this. Under the quantitative corporate failure prediction model, a notable model used is Z-score model. We are going to discuss Z-score model shortly, but I needed to take something in. The Z-score model. Just 1 minute, please. I wanted to use something here. Okay. Okay. Okay, I wanted to do something. I needed something here to is this. We have the Z-score. Now, Z-score is a mathematical model that can be used. It's a mathematical model developed. A mathematical model developed using 5 financial ratios. Let me repeat that point. Z-score is a mathematical model developed using 5 financial ratios to test company at the risk of corporate failure. Please, you can note this down. Z-score is a mathematical model developed. You can note it down. I always encourage students, even if you're on the online class, and I'm sure you are going to have the video after the class, but it doesn't stop you from jotting down. Z-score is a mathematical model developed using 5 financial ratios. To predict company at the risk of corporate failure. The equation of the Z-score is provided on your screen. Please look at the screen. I'm trying to change the yeah, I'm done. Now, please look at this. Look at your screen highlighted. This is the equation of the Z-score. Now, you have Z-score is equal to 0.012 x subscript 1 plus 0.014 S2 plus 0.033 X3 plus 0.06 X4 plus 1.05. The set of weights is given to us by the owner of the model, the Z-score model, Hartman Z-score model. How they come about these weights, the explanation was not provided, and you don't need it. What is important to you for this exam is to try to memorize this equation of the Z-score. Now we now define what is X1. X subscript 1 is called subscript in statistics. This is equal to, let's create space. X1 is equal to working capital over total assets. Your X subscript 2, for simplicity, X2. Your X2 is equal to retained earnings over total assets. Your X subscript 3 is equal to profit before interest and tax divided by the total assets. Recall, Z-score is a quantitative model using 5 financial ratios to predict company at the risk of corporate failure. Your S subscript 4 is equal to market value of equity divided by the book value of total debts. Market value of equity divided by the total value of, divided by the book value of total debts. And your S subscript 5 is equal to sales divided by total assets. Examiner can give you a financial statement of a company. Examiner will now say, use the Z-score model to determine if this company is at the risk of corporate failure or not. You are given a financial statement, the income statement, and the statement of financial position of a company. Examiner now says, use the Z-score model to assess if this company is at the risk of corporate failure. You are now going to state the equation of the Z-score like this. From that financial statement, you are going to calculate X1, your working capital divided by total assets. You are going to get a figure. You calculate X2, retained earnings divided by total asset. You are going to get a figure. You calculate X3, profit before interest and tax divided by total asset. You are going to get a figure. You calculate X4, X5. When you now have these 5 ratios, you now come back to the formula. You now substitute. X1 will be placed here. That becomes 0.0112 multiplied by the figure you have plus 0.014 multiplied by the figure you have here. You are now going to get a result. Now, if you get your result, how do you know if that company is at risk or is not at risk? Look at the criteria. Look at the criteria for decision making. A Z-score of 2.7 and above. If you have a Z-score of 2.7 and above, it's an indication that that company is not at any risk of corporate failure. If you have 2.7 and above, that company is not at a risk of corporate failure. If you have a Z-score of below 1.8, below 1.8, that company is at the risk of corporate failure. If your Z-score is below 1.8, that company is at the risk of corporate failure. If you have a Z-score between 1.8 and 2.7, this is regarded as gray area. Failure is possible, but the company is not at higher risk. Failure is possible. Failure is possible, but the company is not at higher risk. Is that clear, please? Please note it. We move to the next model. We have discussed quantitative. The second model is qualitative corporate failure prediction model. Qualitative corporate failure prediction model. The qualitative corporate failure prediction model argues that company fails not because of financial problems. The qualitative corporate failure prediction model argues that company fails not because of financial problems. So the qualitative school of thought, financial problems are the consequences of failure, not the main causes of corporate failure. To the qualitative prediction model, they argue that company fails not because of financial problems, that financial problems are the consequences of corporate failure, not the main cause of corporate failure. In their opinion, company fails because of non-financial problems. To the qualitative schools, to the qualitative corporate failure school of thought, company fails because of non-financial problems. What are these non-financial problems? What are these non-financial problems? We can discuss this using the Argentine model. If you are trying to discuss qualitative corporate failure prediction model, you can use, excuse me, please. You can use the Argent model. To discuss the causes of corporate failure based on the assumption of the qualitative corporate failure prediction model. We have the Argent model or the Argentine model. The Argentine model. This model uses three major non-financial problems, non-financial reasons. This model uses three major non-financial reasons to explain causes of corporate failure. Let's go to it. We have what we call management defects. Management defects. Where there's management defects, that will give rise to corporate failure. What are management defects? One, an inexperienced managing director. Can you imagine that? Running a company with an inexperienced managing director. That is part of management defects. Or you have autocratic managing director. That's management defects. Why will you put an inexperienced person as the MD of a company? That will lead to corporate failure. Why will you have an autocratic managing director? Managing director that does not consult with the team. He takes decisions without consultation. Number two, management defect. Failure to separate role of chairman and the chief executive officer. If you are combining the position of the chairman with that of CEO, management defects. If you combine position of the chairman with the CEO of the company. That means there is no corporate governance in the company. Is that clear, please? If there is no corporate governance in the business, the company is bound to fail. Failure to separate the role can lead, that's management defects. Passive board of director. A board of director, when you have a board of director that is not active in the business, management defects. Lack of balance in the skills of management team. That's management defects. Inability to respond to change. That's management defects. Where you cannot respond to, where a company cannot identify change in the business environment and cannot respond to change in the business environment. That's management defects.
Hello, sir. We can hear you.
Oh, sorry, I just stepped out. Sorry. Management defects will automatically affect the life of a business. If you look at the arguments between the two schools, that no, this is not company fails, not because of financial problem. Why company fail? Because non-financial problems. These non-financial problems can be categorized into three. One, we have discussed management defects. You can't run a business with inexperienced managing director or autocratic managing director. You cannot afford to run your business where there's no corporate governance, no check and balances. You can't run your business when you have a passive board of directors. You cannot run a business when you are having management team that cannot identify change and respond to change in the business environment. Any of these, like 5 we have discussed, will be discussed under management defects. Number 2, second category, accounting defects, accounting deficiency. Under accounting deficiency, you have no budgetary control system. Imagine running a company without a budgetary control. You can spend money the way you like. Does that make sense to you? You are running a business and we are allowed to spend money the way we like. No budgetary control. No cash flow planning. No cost control. No costing system. We don't have a costing system. That means there's no cost control. Any of these three will be discussed under accounting defects. Then lastly, you have I'll move up too much. Lastly, you have mistake that has been made. We call it error in action. Errors in action. When we say error in action, These are decisions taken by the business. Business decision taken that turned out to be bad. When you say error in action, decision taken by the business managers that turned out to be what? Bad for the business. Decision taken by the directors, by the business manager. When we say business manager, we are referring to the company's management team. Decision taken by the management team that turns out to be wrong. Please note, once there is management defects and there is accounting defects, automatically you are going to have error in action. Is that clear, please? Once you have defects in management, you have defects in accounting, automatically you are going to have error in action. Agree with that? Let's open the line for discussion. Once you have an inexperienced managing director, can that person take a decision that will not go back? You have a board of directors that is passive. Can the board of directors take business decisions that will not go back? Definitely, that will not go back. Definitely, yes. Can they take decisions that will go good, that will go well? What I'm trying to say is, mistake is bound to happen. Where you place an inexperienced person as the MD of a company, mistake will happen. It's not that person is not even experienced about the business, and is the managing director, and that managing director will be taking decision on behalf of the company. Would that person be able to take a good decision? Thank you. Mistake happens because there were defects in the first place. They are connected. If management and accounting system is weak, then mistakes are bound to happen. So if you look at what we have discussed, our second discussion, under corporate failure prediction model, we have two schools of thought that try to explain causes of corporate failure. Why is company, or why are company failing, really? We have the quantitative corporate failure model. The quantitative school is also called the financial model. They believe that companies fail because of financial problems, like profitability problem, liquidity problem. We now have the qualitative corporate failure prediction model. They believe that company fails not because of financial problem. And they argue that financial problems are the consequences of corporate failure, not the main cause of corporate failure. So the qualitative school, company fails because there is defect in management, there is defect in accounting, and there is error in action. Any question, please? Any question, please? Okay. Tonight is discussion problem. Symptoms of corporate failure. If you are to give an example of error in action, look at it, please. Expanding the business too quickly. If you are expanding your business too quickly without cash resources or capital to finance expansion, that is error in decision making. You start a business today or in 1 year with just one branch. You are now rushing. Branch 2, branch 3, branch 2, branch 4, branch 5. You are expanding the business too quickly. You are now taking decision. Let's open, excuse me, please. Let's open a branch in up country. You are opening branches. You are expanding the business without the capital resource to finance expansion. That is error in action. If you borrow too much cash, too much money, of course, borrowing is a decision making. That decision will be taken by the board and MD. If that company is now borrowing excessively, that's error in decision making. You must know when to stop borrowing. If a company accepts a project which subsequently fails, error in action. All right, let's round up this. Symptoms of corporate failure. What are the signs? What are the things you should watch out for that will tell you that this company is not doing well? What are the signs? 1, qualified audit opinion in a row for many years. When you have qualified audit reports, let me throw it to the class. What is qualified audit reports? Let me throw it to the class. What is a qualified audit report? No, the line is open. Oh. You can unmute and speak. I believe Deborah Femi Ellis. I know Zeni. Prosper. Yes, what is qualified audit reports? Where auditor says that this report says that it does not show a true and fair view. Where auditor says that the financial report you have submitted do not show a true and fair view of the business. That is a qualified audit report. Auditor has qualified the report. If auditor is qualifying a report, it means that that company is not giving us the true position. You have prepared a report. The report prepared does not reflect the true position of the company. That means something is happening. It's a sign that, or it's a symptom that something is wrong with that company. And the company is trying to cover up. Qualified audit report is a symptom of corporate failure. If auditor is qualifying a company's report for many years, that means something is wrong with that company. Number two, high staff turnover, where employees are leaving the company. Staff turnover is very high. That could be an indication that that company is not doing very well. A low interest cover ratio. Low interest cover ratio could be an indication that that company is not doing well. If you ask ourselves, what is interest cover ratio? That is the number of times operating profits covers interest payments. The higher, the better for the company. Interest cover ratio shows the number of times the company's operating profit covers interest expense. If you are now having a low interest cover ratio, it means that that company is not generating enough profits to meet interest payments. Now, if you cannot meet interest payments, interest obligation is compulsory. If you cannot meet interest payments, the provider of debt, that is the lenders may take action against the company. The lender may take a legal action to liquidate the company. So when you have low interest cover ratio, it could be a sign that the company is not doing well. Higher operational gearing. What is operational gearing? Fixed cost to total cost. If a company has excessive fixed cost, when we say fixed cost, that cost must be paid, whether or not you make profits. If you are not having too much fixed cost, that's risky for a company. Like your rent is a fixed cost. Whether you make profit or not, you are going to pay rent. You now will tell you, what's my business with your profits? Like your interest rate is fixed. Whether you make profit or not, you must pay your interest rates. If you now have excessive fixed costs in your business, that is risky. Extended overdraft is a clear sign of corporate failure. Maybe you have collected overdraft. You are supposed to pay back in 2 months. You have gotten overdraft, a company has gotten overdraft, and you're supposed to pay within 2 months. Within 2 months. And I say, after 2 months, you are now asking the bank to help you extend the payment period. Why are you extending the payment period? Are you not generating that? You are not making enough cash from your business to settle your short-term financial obligation. It's a clear indication that the business is not doing well. Poor financial ratios. Dependent on a single customer. If your business depends on a single customer, that means once that customer is not available, that business is dead. Where you have creative accounting, it's a sign that, of course, you prepare accounts. The account prepared is not the true position of the business. That's creative accounting. You must be able to go with at least 5 to the exam. Lastly, how do we avoid corporate failure? How can a company avoid corporate failure? To avoid corporate failure, 10 commandments have been provided by Rose and Camille. The 10 commandments a company should observe if that company is to avoid corporate failure. The 10 commandments the company should observe if that company is to avoid what? Corporate failure. One, you must have a strategy. A company must have a strategy if that company wants to survive. Number 2, company must have controls in place. There must be check and balances if that company wants to survive in business. Number 3, the board of directors must participate. When we say participate, the board of directors must be active in the business. You know, a business entity is not National Assembly, where senators can sleep. A business entity, we are in business, we have directors. You must be very active in that business. It's not a National Assembly or House of Rep where you can come and sleep. Number 4, you must avoid a system of one-man rule. If you are the managing director of a company, or you are leading a team, you must avoid a system of one-man rule. Always consult with your team if you want to survive, if you want to avoid corporate failure. Number 5, there must be management in-depth. When we say management in-depth, management must be sufficiently knowledgeable. You can't be leading a team with zero knowledge. You cannot even be leading a team with inadequate knowledge. You cannot be leading a team that you don't have that knowledge. You can't be a management team without knowledge. If you look at reading, knowledge acquisition, there's no stoppage in life. There's nothing like I stop acquiring knowledge. Be it in business, be it in office, be it in, you must consistently add to your knowledge. Number 6, you must keep yourself informed of changes. Companies must keep itself. When we say companies management, you must be informed of changes in the business environment. and you must be able to respond to the change. Number 7. Remember, customer is king. Please remember. You are not doing a customer a favor by serving the customer. That the customer is doing a favor by bringing his business to you to serve him. We are in business to serve our customer. And it is from that service, income will flow. Number 8, do not misuse computers. In our offices, we have access to the computer system. We are giving system rights. Both the management and non-management staff. You have your password. Your password will give you right to the system. You can access company's information. Please do not misuse computer. Because if you misuse computer, it could terminate the life of a business. Number 9, do not manipulate accounts. And number 10, organize to meet the needs of your employees. If a company wants to survive in business, you must recognize the needs of the employee and make arrangements to meet the needs of the employee. That is the end of the first topic, corporate failure. Recall I said we have 2 topics closely related. We have discussed the first one. The line is open for question. I'll give like 8 minutes. By my time, this is 9:52. By 10 p.m., we are going to start the second topic, capital reconstruction. So you can ask your question.
Good evening, Mr. Chadu.
Yeah,
I actually wanted to ask if we'll be getting like these materials after classes and stuff.
The material was shared prior to the class. After the class, yes.
On SFM online group or just SFM?
Yes, the material was shared yesterday on the SFM online group.
I guess I'm not on that group chat and I'll probably look for a link to join.
Okay, no problem. We will share tonight.
Thank you.
All right, let's take WhatsApp. Line is open for question. We have like 7 minutes. Please feel free to ask question. Okay, because it's theory, Abby. So, okay, while I'm waiting, I'm just picking randomly, not Femi Kings. If you are asked that, give us 5 financial symptoms of corporate failure. 5 financial symptoms of corporate failure. Mr. Femi Kings, you can speak.
5 financial symptoms of corporate failure. Bad management, one.
Bad management.
Same audit opinion over a couple number of years. Also, there's you said the one-man rule. You said something about a one-man rule, and you advised against the one-man rule. Then that's, I think those are the ones I can remember off the top of my head.
That's fine. Just to have the class.
Yeah.
If you want to try, I said 5 financial symptoms
Okay, then you for financial system, you said bad P ratio. Did you say P ratio? Yeah, you made mention of a ratio, price
Okay.
earning ratio and some other ratios as well, you know. But I can't remember that off right now. But yeah.
All right. Let's see. Okay. Thank you, Mr.
Mm-hmm.
Mr. King. Debbie, you want to try? No, I'm picking on people. Some people might just log on there once they are already sleeping.
Oh, yeah, I'm driving.
Okay, you're driving.
Yes, I'm listening to the class on the road.
Oh, really? Okay, let's allow you safe trip.
Yeah, no problem. But I'm still following though. I'm still following.
Okay. Debbie is yeah, Believe has been online immediately. Believe.
So I was online, but then I got busy, so I was lost at some point.
You see now. So you are waiting for the video, right?
Yes, sir.
All right, no problem. Fidelis. Okay. Uzeni. Uzain. So you can see what we face. I've been speaking. Uzain, maybe it's also not closer to the system.
I'm here. Fidelis is here, sir.
Okay, I was waiting for you. Please, can you speak? Financial symptoms of corporate failure. Financial.
So what do you want us to do there?
No, I'm just okay. I just try to to ask questions. We've taken the lecture on corporate failure. I want to see how far students are following just to make the class interactive.
Okay. Okay.
I wouldn't know if you are following from beginning so that I
Yes,
just
I've been
trying to
following. You talk about financial failure to be quantitative corporate failure of predetermined model.
okay.
Yeah, it's one of
Okay.
the causes. Yeah, it's one of the causes of
All right, that's
financial
fine.
distress.
That's
Yeah.
fine. Why I asked this question was that it has been tested before. Examiner says state financial symptom of corporate failure. The examiner is very specific, financial. You can talk about poor profitability, poor financial ratios. The examiner
Okay,
says
cash flow.
financial symptoms. If you see a company with poor financial ratios, that could be a sign that the company is not doing well. If you have reduction in revenue is financial. It could be a sign that the company is not doing well. If the company is taking higher gearing, it could be a sign that the company is a sign that the company has too much debt. Financial. If a company cannot repay its borrowing, liquid. That means the company does not have sufficient cash. Financial. Extended overdraft. That means you cannot pay your overdraft as at when. That could be financial. Examiner can deliberately ask you, list 5 financial symptoms and 5 non-financial symptoms. Non-financial symptoms. If employees are leaving the company, non-financial, that's a sign. A company that depends on non-financial, a company that depends on one customer, non-financial, because that single customer, or you are a company dependent on few customers, non-financial. Loss of key staff, where your key staff, your main staff are leaving the company, non-financial. The way these people are living. In every organization, we have what we call the key staff. They understand and they have their impact in that company. If that staff should leave, the impact is going to have on the company business, can destroy the business. Loss of key staff, non-financial. So please, when you get back.
So, sir, sorry, sir. Lack of technical know-how for the staffs. So which of the class? Non-financial? Could it be one of the causes?
No, I didn't say causes, I said symptoms.
Symptom, yeah. I'm just saying I'm just mentioning this from my end. If you have the staffs are not well equipped, they are not skillful in doing their jobs. So could that be a financial or non-financial?
You can now say inadequate training now. Company is not investing in training. You see it now. You have the way you now frame it is looking at, okay, that I observe that this company is not investing in staff development. Non-investment in staff development will that fall under non-financial or financial. If there is reduction in the budget now, every company will have budget for staff development. If you watch it, they say yearly staff development. Where there is reduction in amount spent on staff development, we can begin to say, okay, this company is not setting aside sufficient cash, sufficient money to develop employee. It could fall under financial. It could fall under non-financial, depending on how it is being discussed. Is that clear, sir?
Very well, sir. Very well. Thank you so much. I appreciate you.
All right. Is to keep the class interactive. Now let's move to the next discussion. Capital reconstruction. Capital reconstruction. Our next discussion, capital reconstruction. A capital reconstruction is a major reorganization of a company capital structure. A capital reconstruction is a major reorganization of a company's capital structure. It is usually done when a company is in financial difficulties. Capital reconstruction is a major reorganization of the capital structure of a company. Reconstruction always occurs when a company is in financial crisis. Reconstruction always occurs when a company is about to suffer corporate failure. You begin to appreciate why I say these two topics are related. There are two topics, so independent, but they are very related. Capital reconstruction is a major reconstruction of a company's capital structure. It is usually done where a company is in financial difficulties. For example, if the company is at the risk of financial collapse, the company has cash flow problem, profitability problems. The company probably have cash flow problem, profitability problem, and there's indication that this company may collapse financially. The company may go into liquidation unless urgent action is taken. Capital reconstruction, like the discussion we have, if a company is experiencing sign of corporate failure, the company is about to collapse, definitely the company's directors will not fold their hands. They are going to look at what can they do to salvage the business from eventual collapse. If a company is experiencing financial crisis, difficulties, a lot of things happening. The company is having problem financially, and it's looking like the company is going to liquidate. It is one of the duties of the directors to invite the owners of the business. If a company is experiencing financial crisis and the company is about to collapse, it is the duty of the company's director to invite the owners of the business and explain the situation of the business to the owners. While explaining, the director must think of how to save the business from eventual collapse. While explain to the owners the financial crisis the company is going through, the directors must also say that, okay, what are the options? What can we do? The company. One of the actions that could be taken. One of the actions that could be taken to save a business from collapsing is what we call capital reconstruction. One of the measures that could be taken to save a business from eventual collapse is what we call capital reconstruction. Is that clear, please? So capital reconstruction is a major reconstruction of a company capital structure. This exercise is usually undertaken where a company is in financial difficulties and the possibility of collapse is very high. Unless the capital structure of the company is reconstructed. Capital reconstruction might involve asset revaluation, please note. Revaluation of assets, raising new capital, conversion of debt capital into equity. Look at it. Conversion of debt capital to equity. Number 4, possibly conversion of equity capital from one form to another. 5, existing shareholder might be required to relinquish all their shares and accept a smaller quantity of new shares in the reconstructed companies. Please, This topic will involve calculation. This is the second topic I'm taking you. I'm done with the first topic. The first topic, corporate failure, no calculation or less calculation. For this topic is going to involve calculation. So you might need to pay attention to some certain things and to all things. If you are dealing with capital reconstruction, you might have to deal with revaluation of assets. There could be introduction of new capital to the business. You might have to convert debt capital to equity. You might convert equity shares from one form to another. Existing shareholder might be required to relinquish all their shares and accept a smaller quantity. The purpose of capital reconstruction is to find a way of allowing the company to continue in business. Please notice, the purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid liquidation. Is that clear, please? The purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid liquidation. Therefore, reconstruction is worth considering. Therefore, reconstruction is worth considering if reconstruction is worth considering if it is likely to offer, it is likely to be more beneficial to all the parties concerned than a liquidation of the company. Please note, capital reconstruction is a proposal to the owners of the business, to the providers of the capital to the business. Let me repeat that point. Capital reconstruction scheme is a proposal to the providers of the capital. Look at the case of Opiride. Opiride came into Nigeria. Of course, investors from India, they have gotten a registered company, Opiride, and they were looking at having bike on Lagos Road for commercial purpose. They've gotten approval from Lagos State to operate on Lagos Road. All of a sudden, Lagos State government prohibits or prohibited bike on the road. The company has invested heavily. They bought bikes. Investors have contributed money to run the business. Before you know it, before the business could take off, Lagos State government now outlaw bike on the road after they have issued license to the company. It means that that company business, that particular business has become what? A problem. The business will collapse automatically with that law. Now, what would the company do? They cannot fight governments. An investor has placed their money into that Opiride. The directors must invite the owners. And when we say owners, not only shareholders, the old people that has contributed money to the business. We call it stakeholders. Shareholders has contributed money to the business. Debt holders has also supplied money to the business. Banks has supplied money to the business. They are now the stakeholders. Suppliers that have supplied goods. It's not impossible. Some companies have supplied bike on credit to OP. They are supplied back on credit. They become part of the company's creditors. Creditors are part of the stakeholders. Now, if a company is in financial crisis and the company is considering capital reconstruction, construction is only worth considering if it is likely to be more beneficial to all parties concerned than the liquidation of the company. Number two, if you are talking of capital reconstruction, the reconstructed company must have a good chance of surviving and restoring itself to profitability. Look at it this way. A company is in financial crisis and we are trying to reconstruct the company. There must be some level of assurance that if we reconstruct this company can return back to profitability. And this company can survive. It makes no sense to reconstruct a company, then the company will now collapse later. So please note, reconstruction is worth considering if it is more beneficial to the parties than liquidation of the company. Then the reconstructed company has a good chance of surviving and restoring itself to profitability. A reconstruction will benefit all parties if it is likely to result in them getting more cash or more value. If you are talking of reconstruction, for me to accept a reconstruction, that means that reconstruction must give me more value than if the company is liquidated. Please note, if you are dealing with question on capital reconstruction, you always consider two positions. Should the company be reconstructed? If the company is reconstructed, what will the stakeholder benefit? Or should the company be liquidated? If the company is liquidated, what will the stakeholder benefit? You now compare the two situations. You now make a recommendation. Let me repeat that. If you are dealing with question on capital reconstruction, always remember, you are going to be having two situations. One is, of course, we have been informed that this company is in financial crisis, and the company is proposing a capital reconstruction. You are not going to ask yourself as a professional now, if this company is reconstructed, what will the stakeholder benefits? You are going to put the benefits aside. You now say, okay, if this company is not reconstructed and this company is liquidated, because the company is already in financial crisis, if we liquidate the company and we dispose the asset, what will each party receive? You can now compare the two positions and make recommendation to the parties involved. Reconstruction principles. That is the principle of capital reconstruction. Capital reconstruction is based on 3 principles. One is creditors must not be made worse off. Creditors they will be under liquidation. Please note, receivership is also called liquidation. Creditors must not be made worse off under reconstruction than they will be under receivership, because the agreement of the creditors is required for reconstruction to take place. Reconstruction must not make creditor worse off. Let me explain that briefly. Assuming you have given a loan to a business. You have given a loan to a business. You loan a business. You are giving a business, say, 20 million naira loan. So, in the company's book, you are part of the company's debtor. Debt, Nabi. So you are part of your debt holders. In the company's book, you are part of the debt holders, the provider of debts to the company. The company is supposed to pay you the interest as well as the principal repayment as agreed. So you have given a loan to a business 20 million. And the company is supposed to repay you in 3 years. Annual interest 10% annually on the loan you have granted. Now let's assume that company ran into financial crisis. And the company cannot pay the annual interest, and you are not sure of getting the principal repayments in 3 years' time. So in the company's book, you are a creditor. The company will repay you. You are part of the liability of the company. The company is now proposing that, okay, the company will explain to you, you are the lender, that they are in financial crisis and they cannot repay the loan they have borrowed for you. They cannot even pay you the interest annually. They are now proposing that they want to convert that debt to ordinary shares. The loan you have granted was 20 million. The management of the company is now saying, let us convert this loan to ordinary shares. The loan will be converted to ordinary shares that are worth 10 million naira. That is the proposal to you. Don't forget, it's not a must to accept the proposal. I say, okay, you want to convert the loan I've given you to ordinary share. Once you accept it, that means the company will not repay you the debt again. You are now part of the shareholder of the company. You now ask yourself that, okay, if I don't accept this proposal and the company is liquidated, how much can I get from the liquidated assets? Assuming if that company is liquidated and asset disposed, it is possible for you to get 15 million naira. Will you accept 10 million under reconstruction? 10 million naira worth of shares under reconstruction? Definitely no. Because if that company is reconstructed, you only get shares that are worth 10 million. But if that company is liquidated, you can get a cash that are worth 15 million naira. No creditor must be made worse off under reconstruction than they will be under liquidation, because the agreement of the creditors is required for a reconstruction to take place. Number two, post-reconstruction profitability. It simply means that there must be a good chance that the company will be financially viable and profitable after reconstruction. Principle 3. It must be able to be demonstrated that the reconstruction is fair to all parties concerned. Reconstruction scheme must be fair. The concept of fairness is important in assessing the suitability or acceptability of any proposed reconstruction scheme. If the company is proposing a reconstruction, the proposal must be fair enough. Because if it is not fair, parties will not accept it. Please don't forget, capital reconstruction scheme is a proposal subject to the acceptance of the parties concerned. Steps involved if you are to evaluate a reconstruction scheme. Analyzing a reconstruction scheme, the following steps should be taken. Step 1. Remember the 3 fundamental principles of capital reconstruction. That will guide your solution. Step 2. Consider situation in liquidation. If the company is liquidated, when we say consider situation in liquidation, that is, you are going to assume that if this company is liquidated and the asset disposed, who gets what? That is, how much can each of the parties collect? So you are going to make an assumption. You are going to assume that if we liquidate this company now, how much can we realize? If you realize, how are we going to share? Please note, step number 2 is very critical. The proceeds realized can only be shared in line with Bankruptcy Act. Step number 2 is very critical. When I say Bankruptcy Act, it is the law that specifies how the proceeds from liquidated assets should be shared. You cannot use your initiative or your personal opinion to share the money. The law provides guidance as to how the proceeds generated from liquidated assets, how it should be distributed. We call it priority of payments in the event of liquidation. This priority of payment is provided in the Bankruptcy Act. This priority of repayments or priority of distribution in the event that a company is liquidated is provided in the Bankruptcy Act. Why am I stressing this? When we get to computation, if you are trying to distribute proceed, we are going to be guided by this priority of distribution. Number one is what we call preferential creditors. Number one to be shared to is preferential creditors. When we say preferential creditor, it includes unpaid wages, unpaid pensions, unpaid taxes. If a company has unpaid wages, of course, if a company is in financial crisis and it's about to collapse, it is very possible that the company will not be paying their staff salary regularly again. In fact, one of the symptoms of corporate failure is non-payment of staff salary regularly. If a company is not paying staff salary regularly, and that company is liquidated, then money generated will be used to settle preferential creditors. Under it, we have unpaid wages, unpaid pensions, unpaid taxes. We now have fixed charge secure creditors. We have fixed charge secure creditors. When we say fixed charge, explain this with illustration. Assuming company XYZ. Company XYZ. XYZ PSC has property in different locations in Lagos. Company XYZ PSC. We have property in Ikeja, located in Ikeja. The company has property located in Oregon, property located in Victoria Island, property located in Abuja. That company obtained loan. The company approached a bank to obtain a loan. And the company is using its property located in Victoria Island as a collateral for that loan. Remember the company has property in different locations, Victoria Island, Ikeja, Oregon Road, and also Abuja. But the company is obtaining loan and using that property island as the collateral for that loan. When we say fixed charge, where a liability, loan is a liability, is tied to a specific asset of a company, that is fixed charge. A loan is a liability. That loan is secured on the property of a company, the property located at Victoria Island. That is fixed charge. That is called fixed charge secure creditor. The liability of that loan is secured on property located at Victoria Island. That is fixed charge. Now, what is the implication of this? In the event that the company cannot pay back the loan, in the event that the company cannot pay back the loan, and the company is liquidated, in the event that the company cannot pay back the loan and that company is liquidated, any amount realized from the sale of that property, that particular property in VI, any amount realized from the sale of that property will be used to settle the loan. That loan is secure on that property. So if that property is disposed and cash is realized, that cash will be used specifically to settle that particular liability first. The proceeds realized from the sale will be used to settle that liability first. 1 minute, please. Let's continue. Now you now ask yourself, if the proceeds realized from the sale of that asset is not sufficient to settle the liability, bank cannot go to other properties. Under fixed charge, a liability is tied to a particular asset. In the event that the company is liquidated and the asset is being realized, the proceeds will be used to settle that liability first. If the proceed is not sufficient, bank or the lender do not have the right to go to other properties of the company because it's a fixed charge. The only thing the bank can do or the lender can do is to rank as part of unsecured creditors to claim the balance. Is that clear, please? That is fixed charge. When you get to floating charge, liability not tied to a particular asset, but it is secured on all assets of the company. I mean, if you are done settling, if you are done with preferential creditors, you move to fixed charge, secure creditors. When you are done, you move to floating charge. Floating charge, secure creditors, is where a liability is secured on the asset of a company, not particular asset, on the assets generally. In the event that the company is liquidated, the liability can float to any asset until the liability is fully covered or fully recovered. That's floating charge. So in line of priority, you settle preferential creditors, you settle fixed charge. But I must say this: when you have a fixed charge, where there's a fixed charge, the fixed charge, that particular asset, cannot be used to settle any other person. Even you cannot use it to settle preferential creditors. So there seems to be a conflict in that law. And the conflict is that if the money we have is coming from fixed charge assets, we cannot use it to settle preferential creditors because that fixed charge is tied to a particular liability. So if you are looking at it from accounting substance, it is this person that will get fixed charge. Fixed charge will collect money first because the law secured that asset for him. When you are done with this floating charge, you come to redundancy payment. Redundancy payments. When we say redundancy payments, if a company is to be liquidated, that means the employee will go. The employees will be rendered redundant. Now, where there's redundancy payment, you have to settle it for. After as number 4, redundancy payments. Then next we have unsecured creditors. Followed by preference shareholders. Please note, preferential creditors is different from preference shareholders. Please note, preferential creditors is not the same as preference shareholders. Then lastly, we have the ordinary shareholders. It's the ordinary shareholder that will get money last if a company is liquidated. It is the ordinary shareholder that will get money last if a company is liquidated. All this will happen in your step 2. And that is the critical step anyway. Your step 3 is minor. Cash position of the scheme. Compare, you are going to look at it. How much finance required for reconstruction? You now compare it to the finance available, cash needed for reconstruction against cash available. Of course, you must have sufficient finance to implement reconstruction. That's your step 3. Step 4. Text the post-reconstruction financial viability. Text post-reconstruction financial viability. That is, you are going to evaluate it. If this company is reconstructed, can this company achieve profits and continue in business? Will this company be financially viable after reconstruction? Meaning we are going to evaluate the expected situation post-reconstruction in order to decide whether or not the company is likely to have a financially viable future. Step 4, evaluate the attitude of the creditors group. This is where you are going to write. You now look at it that, okay, you are going to evaluate the attitude of the holder. In your evaluation, you are going to be comparing. If this company is liquidated, what will ordinary shareholder get? If this company is reconstructed, what will ordinary shareholder benefit? You now make a recommendation, okay? You look at the preference shareholder. If this company is liquidated, what will the preference shareholder benefit? If this company is reconstructed, what will preference shareholder benefit? You now make your recommendation. That is, you are evaluating individual creditors group. You look at the bank. Maybe bank has provided loan or overdraft. That's okay. If this company is liquidated, how much can the bank realize? You place in one place. That's okay. Assuming this company is reconstructed, what will be the benefits according to the bank? You now make your recommendation. You are going to evaluate for individual parties. Based on your evaluation now, you cannot draw your conclusion. Okay. It's a good way. The line is open now. I'm done with the explanation. Assuming we want to start now, of course, we can't solve question again now. We are good to solve question. So, in the next 10 minutes, the line is open. Ask your question. Someone has gone to sleep, oh. They are tired.
Okay, I have a question, sir.
I believe.
In a situation where we have, let's say, 15 shareholders in the company, and then maybe 10 are saying, okay, let us liquidate, and 5 are saying reconstruction is the best. So in this situation, like, what would be the final decision? Since
All
some
right.
are saying, okay.
Okay, it's a good question. One of the problems with reconstruction is to have a reconstruction scheme that will be beneficial to all parties. Now, if some shareholder says reconstruct, some says liquidate, final decision will always come from the position of law or government. Government will, the same way if you register a company, you apply to government, you apply to corporate affairs, a government agency, to register a company. If a company is to be liquidated, then government must be involved. Now, where there's disagreement between the parties, government will now step in and say, okay, government will not usually agree to liquidation. You understand why? Because if you liquidate a company, it has negative effect on the economy. That means you are going to lay off the staff. And government is trying to achieve what? Higher employment opportunity. So government will always try to avoid situation where company is liquidated. But if the situation cannot be helped, so if there is disagreement now, they will now come into persuasion and understanding. The government will step in and try to advise parties on how to deal with it. So for us, we look at the financial aspect more. Disagreements will come under legal will come to play. So you have what we call technical feasibility, financial feasibility, legal feasibility. A lot of things will come. But because we are accountants, our focus is on the financial aspects of capital reconstruction. So we assume that they will agree with themselves. Any other question, please? You can drop your question via chat. All right. If there's no question, please, I will recommend that, or I will say that, please, if you get the video, look at it often. When we get to our next class, once I do 15 minutes introduction, we are starting to solve questions. So do have a blessed evening. God will give us a better understanding. Good night and remain blessed. I will be checking out of the classroom.
Thank you, sir.
All right, good night.
Awesome.
Thank you so